But I think basically that we'll get more demand and more price increases because when you compare it to currencies of major countries that are in fiscal dominance, gold is more attractive. So I've had gold in my kind of model portfolio since 2018, and
Nice.
it's been a good choice versus Treasury bonds, and I still view the conditions as being there. I mean, there are multi-year periods where gold just kind of chopped along sideways. Other years where it went up quite a bit. And I think we're going to have more of those types of cycles. But I do think that this is a multi-year period that is good for gold in a similar way that the 2010s was a multi-year period that was pretty bad for gold. I think we're in the right
Right.
part of the cycle.
Let's talk about the Fed and their actions yesterday regarding their decision to cut 50 basis points. Did the Fed just open up Pandora's box coming out with that 50 basis point cut, which hints to the markets that either the economy's in worse shape than being reported, or they have to get ahead of this colossal wall of debt that's maturing? They're doing this all while at the same time real estate, stocks, and food prices, like we were saying, are all at all-time highs. In your examination, will this unleash a new round of high inflation?
I think not right away, but I do think that we are kind of entering the next global liquidity cycle. So I think the relative monetary austerity of 2022, 2023 is kind of behind us. And now we see, we're back to money supply growth in the US and elsewhere. Um, and, I think that what's interesting is that this cut was the first one in a while that the market wasn't sure about. Usually, the Fed telegraphs very clearly what they're going to do, and going into that day, the market's nearly 100% sure what they're going to do. This one, the market, even in the couple days before, it was kind of 50-50 on whether or not it'd be 25 or 50 basis points. They went with a more
Yeah.
dovish approach. Um, the way they would frame it is one, unemployment. They don't want it to get any softer. The way they measure it, they don't really want that to worsen. And two, they would argue that even if they held, so if they hold rates flat, but official measures of inflation decrease, then they're actually getting more hawkish over time because their real rates would be increasing. So let's say inflation's 5% and rates are 5%. If inflation falls to 3%, while they hold rates at 5%, they would argue that they're kind of gradually getting hawkish over time, even just by doing nothing. And so their approach is say, well, if we cut 25 or 50 basis points, we're still being like not accommodative. It's just that there's a lower level that we're being hawkish from. That's I think how they would describe it. Um, and I think overall that one of the challenges of fiscal dominance is, if you look at, there are periods of monetary dominance. So for example, the 70s was a period of very rapid bank lending. The baby boomers were entering their home buying years. There's faster than normal bank lending happening. That's where most of the money creation was coming from. Um, and public debt to GDP was only like 30%. And so if you raise rates super high, you can slow down that bank lending more quickly than you increase your interest expense that pours out into the economy. The problem is that in this cycle, because we're in fiscal dominance, we have 120% debt to GDP. Bank lending was not the problem this time. Bank lending is average in the United States. It's not particularly fast. And raising rates does slow down that bank lending a little bit, but it wasn't the problem in the first place. And it actually increases the deficits, which are actually the source of inflation. So interest rates don't have that quite as clear relationship with controlling inflation as we associate them with back in the 70s and 80s. And so that's part of the reason I expect these deficits to be structural is that the Fed's kind of stuck in a no-win situation where if they keep rates high, it means the deficit keeps blowing out even more, which eventually can be inflationary again. And if they cut rates, then they can weaken the dollar. They can emerging markets can get a little bit of a boom because their dollar-denominated debt weakens. They can increase their energy consumption and other things like that, and then you can get more inflationary pressures. And so either way, this is, I think, a background issue that they're going to deal with for years.
Okay. All right. So, Lynn, given the law of diminishing returns for money printing, do you expect the Fed to continue printing money in the future, meaning when they deem it necessary, despite the potential risks? Or will they avoid further inflation by limiting money creation and accepting the potential economic consequences when they're faced with them?
I think that they're going to keep money printing, mainly to save the treasury market. So I'm not sure we'll see the fast rate of QE that we've seen in an effort to stimulate the economy. But basically, I think that whenever the treasury market becomes illiquid, they will basically go back to supporting it. So, for example, the last time quantitative tightening ended was September 2019. They had been reducing their balance sheet.
Mm-hmm.
Eventually, the repo rate spiked, and everybody was focused on the repo rate. But there were some analysts, such as myself back then, saying it's actually a T-bill oversupply problem, and that they're actually, right now they started responding with repo support, but then they're going to start buying T-bills soon. And then by the time we got to October, the Fed said, actually, we have to buy some T-bills. We're going to go back to buying T-bills, but we're not going to call it QE. I think we're probably going to see something like that by late 2025. There's different variables that they could push it a little bit, but I think essentially we go back to they're gonna call it basically bank reserves. They want to maintain ample bank reserves, and so basically when the reverse repo facility is mostly drained and all this debt's still pouring out, I do think the Fed's going to go back to kind of gradually increasing the base money supply by gradually increasing treasuries. And if you look at the New York Fed's projection, they already project this, but that by about 2025, they'll have a pivot where they go back to balance sheet increases. One difference that they do plan to do is they don't want to keep supporting the mortgage market. So they plan on letting the mortgage-backed securities keep maturing off their balance sheet while they do go back to treasury accumulation. So I do think that they're probably going to simplify their balance sheet, but not shrink their balance sheet beyond roughly a year and a half from now.
That's interesting. All right. So, Lynn, Ken Griffen, Jensen Huang, Stanley Druckenmiller, George Soros, Dan Loeb, Ray Dalio, they've all been aggressive sellers of NVIDIA in 2024. Warren Buffett's been aggressively selling Apple. There's other examples of big whales and corporate insiders selling. Tech has led the huge rally in the markets since 2023, mimicking the dot-com bubble through 2000. In your analysis, what is all of this major tech selling telling you?
Well, so we went through a period of somewhat slower economic growth and very high fiscal deficits, but also pretty tight monetary policy. And so you get a divergence between sectors depending on if they're on the receiving side of deficits or they're on the punished side of high interest rates. So if someone is say operating commercial real estate, they're being impacted by the high interest rates, but they're not really benefiting from the deficit. Whereas if someone works in healthcare or travel and leisure that a lot of retirees are going to and using those services, especially coming out of the kind of the pent-up demand of the lockdown periods. Those areas were
Mm-hmm.
doing fine, and tech was an area where a lot of tech companies, especially in this rally, it was not like the ARC type tech. It wasn't like the unprofitable tech. It was the profitable tech companies, and
Right.
so a lot of them have more cash than debt. And the debt they do have is locked in with very low interest rates, fixed rate. And so every time the Fed increases interest rates, Google got a raise. Google just, their big cash position would get a raise, and their debt is fixed in little compared to their cash. So they were on the right side of interest rate increases. And so basically, there's been like this almost unintuitively like a risk off rally, which is everybody said, I don't want to hold banks, I don't want to hold energy, I don't want to hold cyclicals, I want to hold tech, big monopoly like tech stocks, as well as other stocks like Costco. Costco is trading at like over 50
Yeah.
times earnings.
Yeah.
And people said, well, I want to own that because it's bulletproof. I want to own Costco. So all the money's kind of piled into these kind of mega cap, low earnings volatility types of names, as well as an AI enthusiasm on top of that for companies like Nvidia. And I think that got overdone. I think we've seen some rotation out of that. I think there's a lot of profit taking, which I think makes sense. Um, these things tend to go through capex cycles and get overdone for a period of time. One of the challenges with Nvidia is that they're making a lot of money, but all the companies buying GPUs are not really profitable yet. Like they're providing services and losing money, trying to figure out what their business model is going to be in this pretty rapidly evolving period. So I think that we could go through a period of consolidation where people have to kind of say, well, wait, I mean, should we be buying this many GPUs, or we're gonna have to increase the cost of our services, which might slow down the demand for those services in order to try to break even a little bit better. And I think one of the more interesting beneficiaries of the cycle could be emerging markets. Generally speaking, any sort of Fed rate cutting cycle is a window where they can do pretty well. The 2019 cycle was the last time there was Fed cuts from a recent high, but that was obviously heavily disrupted by the pandemic, the lockdowns, the less travel happening, energy disruptions, and so that didn't really rotate in the way that it potentially could have. But I think this cycle has a better chance of doing that rotation, where some capital gets out of the U.S. and goes to some of these beaten down and expensive emerging markets that have dollar-denominated debt at a time when the Fed is cutting interest rates and therefore easing the dollar.
Interesting. Okay, so economists everywhere, they're debating the likelihood of a 2025 recession with mixed economic signals, including a rising unemployment rate and an inverted yield curve. What is your analysis on whether a recession is imminent or not?
The short answer is I don't know, but I have a couple sub answers there. One is that by some indicators, we had a recession in 2022. So again, like I mentioned before, Misery Index, which is unemployment plus inflation, that hit recession levels. Consumer sentiment hit record lows in the U.S. If you look at bank senior loan officer surveys, whenever they have a really fast tightening in their lending standards, that's historically been associated with a recession. And they had one of those throughout 2022, which is now easing. They're coming out of that, and so by kind of if you take out the fiscal deficits for a second and say what if you look at the private sector and look at the bank credit cycle, there were some recessionary variables there where it didn't show up as unemployment, and it didn't show up in real GDP. And I would say a lot of that's because we had post lockdown just changes in the economy, plus that fiscal dominance that we're in, which changes things. When we look at 2025, the question is unemployment going to keep rising? Historically, when it goes from 3.4% to 4.2%, when it has a move like that, it more often than not, it keeps going for a period of time. And that's the big concern that people have, because if you get that unemployment cycle, then people buy less, and then other companies lay people off, and you get that kind of vicious cycle. I don't know yet, admittedly, whether or not we're going to get that, but my base case would be that even if we get that, I do expect that the unemployment cycle will probably be less extreme than other recessions that we're used to. So I don't think it would be like 2020. I don't think it'd be like 2008. I think it'd be more like the 2001 recession, which was, it was by most indicators, it was not as severe as like the two recessions that came before it or the two recessions that came after it. The unemployment cycle, the real GDP, like year of year change. So I think that recessions look a little bit different when you're in fiscal dominance, which my base case would be less disinflationary than we normally think of recessions, but also potentially a little bit less credit cycle focused and a little bit less unemployment focused, even if we do get that recession.
So if we do get the recession and it looks more like 2001, and the unemployment and the GDP the unemployment doesn't rise as much as the typical recession, and the GDP doesn't fall as much, do you also though expect the markets to drop? Maybe not as similar, but in a profound way as it did during 2001 to 2002?
So 2000 had higher valuations in most metrics, not all metrics, than we have right now. I think partially that will depend on what global capital wants to do. If global capital, which is currently really stuffed into the U.S. market, wants to leave, then you could get that more significant bear market. Also, back in 2001 and 2, we didn't have fiscal dominance back then. If anything, we basically had a surplus. We were coming out of a surplus. And so I think that the background is kind of like we're almost pre-stimulating before we would even go into a recession, which I think impacts that recession somewhat. Also, right now, when I compare equities to bonds, like let's say 10-year treasuries, it's not like I really want to pile out of equities and into treasuries. It's just neither of them are maybe super attractive. And so instead, there's some assets that are more interesting, I think, but not really the biggest assets. And so I think that's the trouble that the market goes to. My base case would be less of a market decline than the post-dot-com bubble decline, but one that instead could be more just drawn out. You could have a sideways choppy market for years that, especially in real terms, doesn't do very well. If you look at, again, if you look at that emerging market recession analog, often you'll say, well, what are equity prices doing in local currency terms? They're going up. Well, what are they doing in dollar or gold terms? Usually going down. And if it's the dollar itself going through a similar situation, I think, for example, equities probably underperform gold over the next 3 to 5 years, or at least even if they do outperform, I don't think it'd be by much. Basically, I think that just there's already evidence that equities are rolling over in gold terms. So we'll see how much legs that has to it. But um, I think that nominally, they my guess would be not great returns and chop along and just kind of be uninteresting. And that depends on what sector you're in.
Sounds a lot like the 60s into the 70s.
Yeah.
In let's stay on the gold theme for a moment here. In your analysis, why would central banks ultimately buy record amounts of gold instead of buying treasury bonds at a 4% yield or whatever it was? What is that shift really saying to us?
Well, one is that if you just don't want someone to be able to press a button and your assets or your national assets are confiscated, frozen. So that's number one. That's not really that's more of a qualitative decision than a quantitative decision. Quantitatively, so historically, the U.S. money supply growth going back to the 60s grows at about 7% per year on average. Some periods, like in the mid 90s, slows down. Other periods, like during the pandemic, it would spike up. But that kind of multi-decade average is about 7%. If you look at developed countries in general, it's like 6 to 8 or 6 to 9%, in that range. They all have pretty similar money supply growth. Obviously, developing countries generally have much higher money supply growth. But the point is, if you're getting a 4% yield on something that grows in supply by 7% per year, you're kind of getting a -3% net dilution as like a share of that network. Like the share of all treasuries owned or the share of money supply owned, you're not really keeping up. And so in gold terms, gold, you don't get a yield generally, but you're only getting debased by mining at a rate of 1 to 2% per year, on average about 1.5%. And so any time where the yields compared to money supply growth go below like -1.5%, then gold looks pretty good in comparison. If you were getting paid 8% on treasuries and money supply is only growing by 6%, then you might actually have a case to hold treasuries for a little while until that high yield goes away. But if you're not in one of those pretty rare environments, like we were, for example, in the 80s, we were in that type of environment, which is again why gold did pretty poorly in that environment, because there was a pretty good case to hold treasuries. But when we're locked into this more dilution period, gold looks pretty good quantitatively. In addition to, uh, if a central bank holds it, anything short of invasion, no one can just take it. It's expensive to take it.
All right. So, data from the World Gold Council shows that physically backed gold ETFs, they've seen global inflows rise for 4 months in a row. And tucked away within the data, America even outpaced Europe and Asia this summer. Is the Western financial advisor and investor beginning to wake up to what's happening? And if so, what does this mean for the price of gold as more and more of these advisors and these investors rotate assets into the gold space?
Yeah, it's interesting because for a while in this rally, that wasn't really happening. It was like it was not really showing up in ETFs. It was showing up in central banks and East Asia. That's where the demand was. Finally, when you get enough price momentum, it's finally woken up the kind of the domestic audience to some extent. I don't have a personal view or data on whether that's advisors, whether that's individuals. Generally speaking, advisors don't have very high gold allocations for their clients. It depends on the advisor, obviously. And so I think that, kind of price begets price. There's also hedge funds and other institutions can basically say,
Mm-hmm.
well, I want to have this for a trade because it's going up. Um, and the fundamental backdrop's there, so a cutting cycle, um, kind of it broke out of a very long basing period, so it got a lot of capital interested, um, and so I expect one of my concerns is that right now gold's a little bit overbought and the dollar's a little bit oversold. So I
Hmm.
wouldn't be surprised to see some consolidation. But I'm not really trading around that view because I think when we look back 5 years from now, I expect gold to be higher. And so that's an asset that I want to keep exposure to. And instead, I just kind of manage my expectations around this. But I do think we're seeing that little bit of rotation where there were some buyers that kind of started the rally and then other buyers that have added to the rally, but there's still not any sort of like broad scale over enthusiasm, I would say. There's still not like
No,
on the financial
definitely not.
networks, there's not a lot of gold enthusiasm.
Right.
I was around in 2011 when gold had its prior big multi-year top. And back then, I mean, gold was like all over the place on financial media.
Hmm.
And we're not really replicating that type of extreme environment yet.
Yeah, so Lynn, I know that you're not a mining expert, but I do have a question for you here. In the past 50 years, we've exhausted the most accessible gold deposits. Now mining gold, it's more challenging due to the increased depth of the deposits and even trying to find larger ones. With growing global demand for gold as a trade settlement currency and inflation hedge protector against purchasing power loss, would you say the stage is set for a significant price increase considering the challenges around mining?
So I think that any sort of high stock to flow ratio commodity is more dictated by non-mining factors in any sort of multi-year period because there's so much existing supply that can be mobilized should there be new buyers coming in. Um, so mining is relevant, but it kind of shows up over longer periods of time. Um, And so with gold case, I do think, and the way that I've described it is kind of a difficult adjustment built in because our technology improves, we get better at
Mhm.
mining, but then we, like you said, we get the easiest deposits, and so we're left with the harder deposits. So even as our technology's improved, gold supply growth per year has, even though the tonnage goes up, so does the existing supply held by all central banks, all market participants around the world. The estimated supply goes up, and so the percent supply increase per year stays in this really narrow band of like 1 to 2% is pretty interesting. And I don't really see us breaking out of that anytime soon. We'll see what happens. But I think basically that we'll get more demand and more price increases because when you compare it to currencies of major countries that are in fiscal dominance, gold is more attractive. I've had gold in my kind of model portfolio since 2018, and
Nice.
it's been a good choice versus treasury bonds. And I still view the conditions as being there. I mean, there are multi-year periods where gold just kind of chopped along sideways. Other years where it went up quite a bit. Um, and I think we're gonna have more of those types of cycles. But I do think that this is a multi-year period that is good for gold in a similar way that the 2010s was a multi-year period that was pretty bad for gold. I think we're in the right
All right.
part of the cycle.
Good. So gold stocks, Lynn, they're at historically low valuations despite record high gold prices. Now they have rising gold prices coupled with falling oil prices and falling interest rates. This setup should positively impact the mining balance sheets. With strong profit margins and a potential for significant upside in your analysis, are gold mining equities an attractive investment opportunity right now?
I think so. I generally leave them to experts. I have a handful, but I have a smaller allocation than I have, generally speaking, compared to gold itself. Kind of my approach with commodities is that for high stock to flow ratio commodities like gold and uranium, I generally prefer to hold the underlying one way or another. Whereas for things like oil and gas, I generally prefer to hold the producers rather than the underlying. But for gold, I also do own some of the streamers and some of the miners, or ETFs thereof, both individual stocks and ETFs. The performance has been disappointing in recent years.
Mhm.
Obviously, back in 2022, the big increase in energy costs was a problem. If one of your major expenses, directly and indirectly, is oil and gas, even things like tires for these big vehicles that are replaced on a regular basis, things you don't
Yeah.
think of,
Yeah.
very oil and gas heavy. That's not great. Um, because I'm kind of a long-term bull on both oil and gas and gold. I've been a little bit hesitant to be too excited about the miners, but I do think that in this current period, as gold's like 2,600 and oil's still in this like long range bound pattern and interest rates are coming down, I do think that if there's a chance for gold miners to really break out of this kind of bear market that they've been in, I think this is probably the time to do it. So I would just make sure you know what your own and that for the person listening, just it's not an easy business. Mining is just inherently a very hard business, and so I leave the smaller ones to experts because I can't focus on everything.
So you brought up uranium in that answer, and I just want to touch on that real quick. Uranium, as far as sentiment, has dramatically improved over the last 12 to 18 months. Price has it's shot up and it's come back down and consolidated around $80 a pound. But as far as looking out, as far as the eye can see, based on the needs for energy and the data centers and everything else that's going on, nuclear power seems poised to do incredible things, to expand dramatically, and uranium would be the beneficiary. Do you see it as that?
So I've been long uranium for 4 years now. The effective entry price was around 24 because it was like back then it was about $30 or 29, but then some of these were trading at like some of these holding companies were trading at like 20% discount to NAV.
Right.
So you could get an effective buy-in price at like 24, 25. And I've been holding the whole time. There are periods where it's a little overbought, but I'm like, I still want to hold this for the next 5 years. So I'm just kind of letting that position run. Kind of like gold, I don't really see a catalyst to sell it yet. I think the cycle still has legs to it. The supply side is tight. They're not producing as much as used, so they're taking supply out of secondary market. Basically, former military uses is over time, decades of that has been repurposed to civilian usage. That market is kind of opaque. People don't really know when that gets like acute, when there's just not really the tonnage. That's why uranium sometimes has these crazy vertical spikes, because you have very price insensitive buyers that just have to buy at any price because they have $1 billion facility that
they're not shutting that down.
They're not shutting that down. Right now we're seeing we're seeing Germany, they shut off their nuclear plants. The U.S., we don't really see much growth, but when you look at the BRICS countries, they're moving forward with energy. And I spent the summer in Egypt. I go there every year, and they have acute energy shortages, electricity shortages. They're rolling brownouts, and one of the things they're doing is they're building their first nuclear facility on their Mediterranean coast, which potentially can supply like 15% of the country's electricity when it comes online.
Wow.
And there's a lot of Middle Eastern countries that are building it. China's obviously building a ton. So I think this has long-term legs to it, both on the supply side, and then all demand has to really do is not collapse. It just has to kind of go sideways or mildly up, and not have some sort of big, nuclear disaster that makes 20% of the global fleet shut down or something. And I'm pretty bullish, and it's rather unconnected to the economic cycle. So it's just kind of like this uncorrelated thing that's kind of doing its own as a small slice of a portfolio.
Great way of putting it. So this has been a wonderful conversation. Before we wrap up here and I ask Lynn our final question, I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Lynn as much as I have. Please let her know. Hit that like and subscribe button and leave a comment below the video. It's now time for our Golden Nugget segment, which is sponsored by the Naples Family Office Symposium, which is going to be held this year in Naples, Florida on October 3rd and 4th. The Naples Symposium, it's focused on uniting family offices, wealth managers, and other sophisticated investors through leading experts adept at navigating today's intricate market dynamics. So go check out the Naples Symposium. The link is in the comment section below. Lynn, let's discuss portfolio positioning. Understand that you're not a financial advisor, and based on all we've discussed today, and with your experience and your worldview as the backdrop, how are you positioning for the next 12 months? I know you said gold and I know you said uranium. What other assets do you like, and what assets do you absolutely want to stay away from?
I generally like emerging markets and Bitcoin here as, slice of a portfolio. Generally you have to mitigate their volatility to whatever makes sense for your portfolio needs, but I do like them as part of that portfolio for the next 12 months. Kind of more structurally, my approach right now and for a while is a three-pillar approach. So instead of the 60/40 stock bond approach, which is really geared toward expecting disinflation, I have a three-pillar portfolio, which is one pillar of equities, which includes global equities, domestic and global equities, and then one pillar is like cash equivalents, T-bills, tips, generally the shorter duration types of things. That's more for liquidity contractions and things like that. And then one pillar is basically commodity producers and hard monies. So the energy stocks, the uranium position, the gold position, the Bitcoin position, maybe certain infrastructure assets, things that generally hold up better in the period of debasement, period of inflation. And so I feel like those three pillars generally work pretty well. As far as things to stay away from, when I see a stock like Costco trading at 55 times earnings, it's already, if you would ask me 12 months ago, would I buy it? No, and it's done okay. So I don't know what it's going to do for the next 12 months. But the area that I'm staying away from is what I've called that risk off bubble, which is that there's so much capital that just wants to own these really good blue chip companies, but for prices that I think are out of range compared to what they're probably worth. And so you could have a bulletproof company, but not a bulletproof stock. So that's where I'm a little bit concerned.
Makes sense. Now, are your three pillars equally weighted?
No, I think basically every investor has their own age, risk tolerance, volatility tolerance. I generally am more equity focused than many investors. Because I'm involved in the Bitcoin space, I'm willing to weight that a little bit higher than what you would typically recommend in someone's portfolio. So everyone has to kind of tweak that to what they're expecting their portfolio to do.
Understandable. Well, Lynn, thank you for coming on to Metals and Miners and for being so generous with your time and analysis and your ideas. It's been wonderful to spend this time with you. Would you please share with the viewers any important message that you want to leave with those tuning in, where they could learn more about your work and how they can connect with you?
Sure. People can check out lynnalden.com. That's where most of my research is. And I'm also available. You can buy my book, Broken Money, either on Amazon or elsewhere. And I think the main thing I would leave people with is that, I think this is a really good time to think strategically rather than tactically, which is to say, what do I think the next 5 years are roughly going to look like? And what are the different scenarios that could play out that surprise me? And how do I want to position to do reasonably well in most of those scenarios? Maybe more so than just what's going to happen in 3 months, what's the Fed's going to do in their next meeting. I think it's more about what is reasonably priced and in demand and looks pretty good over the next 5 years versus what is maybe overbought right now.
That's outstanding advice and an incredible ending to this wonderful conversation. Everybody, if you're not following Lynn, you need to go get her book on Amazon, follow her on Twitter. She is a wealth of information. She's just so level-headed and filled with with incredible vision for the future and understanding of what's happening now. So she's a must follow. Lynn, thank you so much for being here with us, and I look forward to having you back on sometime soon. And everybody else, thank you for watching. I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one, they're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us.